If you're a business owner clearing $250 to $500,000 a year and you're writing the IRS a six-figure check every spring, by the end of this video, I'm going to show you exactly what I would do step by step to legally bring that number as close to zero as possible. So let me tell you up front what this video is and what it isn't. This is not a video about loopholes and tax hacks. It's not a video about gray areas or really even aggressive positions that keep your accountant or spouse up at night. This is about using the tax code the way it was written to be used, because the tax code does not just punish income, it rewards investment. And if you're at that income level and you're not using what I'm about to walk you through, you're leaving real money on the table year after year. This video is specifically for business owners who are already generating consistent profit and want to know how to redirect what they're currently handing to the IRS into assets they own and that grow over time. So let me give you the framework before we get into the mechanics. Think about your business income like water going into a bucket. Right now, every year, the IRS and the state punches a hole in that bucket, and a meaningful percentage of everything you pour in drains right out before you can use it. So what I'm going to show you is how to plug that hole, not by making less money, not by hiding anything, but by creating legal paper losses in another part of your financial life that offset what you owe. And here's the part that feels counterintuitive until you understand it. You can own something that generates real positive cash flow every single month, cash in your pocket, and at the same time show a loss on paper that the IRS fully recognizes. And those two things can be true simultaneously. This is what makes this strategy work. And the concept that makes it possible is depreciation. Depreciation is one of those words that sounds technical, so let me give you the version that actually makes sense first. If you buy, for example, a delivery truck for your business, the IRS doesn't let you write off that entire purchase price in year one under the standard rules. They make you spread that deduction out across several years to account for the fact that the truck has a useful life, and it's really aging and losing value over time. Real estate works the same way. When you buy a rental property, the IRS requires you to write off that structure over 27 and a half years and sometimes more. So if you buy a $700,000 property, normal depreciation rules give you about $25,000 a year in deductions. And that's nice, but not great. But we're not stopping there, because the real leverage in this strategy is not standard depreciation. It's what happens when you accelerate it. So here's what the average business owner does with real estate. They hear, invest in real estate, you'll get tax benefits. So they go buy a property and they hand it maybe to a property manager. And then they wait for a check to show up. Maybe they pick up a long-term rental or like a duplex. So the tenants are going to sign a 12-month lease and they're hopefully going to pay rent every single month. And those investors do get some depreciation at the end of the year, but there's the problem. Long-term rental income is generally treated as passive by the IRS. Your business income is active. And the IRS has what are called passive loss rules, which means in most situations, you can't take losses from a passive rental and use it to reduce your active business income. Those losses get suspended or significantly limited, and they just kind of sit there and wait until you sell the property or buy another one. So you own real estate, you're getting depreciation, but it's not doing the job you need it to do right now, which is cutting this year's tax bill. That's the wrong approach. So here's the right one. If I were looking to slash my tax bill, I would start with a short-term rental. Think about like Airbnb or VRBO. A property that's listed for stays of 7 days or fewer on average is what we're looking for. And the reason I start here is pretty specific. The IRS treats short-term rentals different than long-term rentals. That 7-day average stay is pretty significant. It kind of makes sense because of the nature of the activity. You're dealing with multiple guests, you're managing turnovers, you're running functionally a hospitality operation. So the IRS doesn't automatically classify short-term rental activity as passive. That means if you meet the participation requirements, which I'll get into in a minute, the losses your short-term rental generates can offset your ordinary business income. And that one distinction is the entire foundation of the strategy. So here's a target I'd be working with. If I'm making $400,000 a year out of my business, I want to find a short-term rental sized and underwritten correctly that generates real cash flow and enough paper losses to offset a meaningful portion of my income. So I'm probably going to be looking at properties in the $600,000 to $800,000 range or more. And if I were doing this, I would want something that already has a rental history. I don't want a project because I don't want to guess at what this thing is going to generate. I want actual numbers. So if the property is already producing $70,000 to $90,000 a year in gross rental income after the platform fees, I'm going to take this pretty seriously. Now here's where the leverage really comes from. Once I own the property, I'm going to hire an engineering firm to do a cost segregation study. What a cost segregation study does is it breaks the property down into individual components: the structure, the appliances, the flooring, the plumbing fixtures, the electrical fixtures, maybe the landscaping or furniture. And each of those categories has a different depreciation schedule than normal real estate improvements. So it's a shorter schedule than the 27.5 years, which means we can take bigger deductions every year. So some components may depreciate over 5 years, some over 7. And with the bonus depreciation provisions that have been restored under current legislation, a significant portion of those shorter lived components can be written off in full in year 1. So on a $700,000 property, a cost segregation study can identify somewhere between 20 and 30% of the total value as components eligible for accelerated or what's called bonus depreciation. So we're talking $140,000 to $210,000 in deductions in year 1 alone. And if you add on the regular structural depreciation of about $20,000 and you add in your operating expenses like your mortgage interest, insurance, property management fees, maintenance, upkeep, call that $40,000. And then you subtract your gross rental income of $80,000 in this example, you're generating a paper loss of $120,000 to $190,000 on a property that's also depositing cash into your account because your rental receipts are higher than your cash expenses. So on $400,000 of business income, that one property cuts your taxable income by 30 to 45% in year 1. So do this twice over a couple of years and you've dramatically changed your tax picture while building real equity in real assets. Now let's talk about timing for a second. The best time to get your cost seg done is in the year you acquire your property. But if you already own it, you actually have until you file your taxes to make a decision around how you'll account for depreciation. So if you already have a short-term rental or we're approaching the tax filing deadline, you can possibly still have the study done and capture those benefits on this year's tax return. But whenever possible, I like to capture the benefits in year 1 because that's when you probably had the biggest cash outflow because of your down payment. And look, I know what's going through your head right now. You're thinking, Adam, how's a property I'm making money on showing a loss on paper? Doesn't the IRS see right through this? And the answer is no. Here's why. There's actually 2 less informed schools of thought on this. The first is that you can just write off your entire purchase price in year 1, but the typical deduction rules don't allow that. And I've had some prior clients get really burned on that assumption that nobody corrected for them. The second school of thought that's incorrect is that you have to depreciate all of your purchase price over 27.5 years, especially if it's a residential investment. That's not how the rules work. Depreciation is a non-cash deduction. So the property is generating real income and real cash, but the tax code says there's a cost to owning this asset. The wear and tear, the aging of the structure and its components over time. And you're entitled to recognize that cost as a deduction. Bonus depreciation is the same thing. The government deliberately built that incentive into the code to encourage investment in real property and equipment and machinery and other things. So you're not creating a fictional loss. You're recognizing a real economic cost that the tax code has specifically authorized. This is not gray area. This is not a loophole. This is the system working exactly as it's designed to work. It's written right into the tax code. I've seen what this looks like in practice for the clients we work with at Pennywise. I had a client not long ago making about $370,000 a year from his business. Decent margins, but paying federal taxes as if he had 0 options. So we walked through this strategy. He acquired his first short-term rental, which he actually takes his family to occasionally. There's limits on that. So we ran the cost segregation study, and in year 1, he offset over $140,000 of business income with paper losses from that property. And then after stacking some other strategies that his prior accountant missed, he still had a tax bill, but it was a fraction of what it had been. And by the way, his family now owns an asset that's gone up in value and is generating cash flow every single month. That's what this is supposed to look like. Now, I need to be straight with you about the participation rules as well, because this is where people get into trouble if they're not paying attention. The IRS doesn't let you treat this as a mailbox check investment and still claim the losses against your active income. You have to materially participate in this new business, your new hospitality business. So there are specific tests that you have to meet. But here's what most people miss. The clock isn't just running when you're managing guest check-ins. The time you spend researching your properties counts. The time you spend coordinating setup and furnishing the property and staging it counts. If you're reviewing your occupancy data, managing your vendors, overseeing operations, all of that counts. And if you're running this as the real business that it is, meeting the participation threshold is really pretty easily achievable. But of course, you've got to track your time as well. We always need documentation. So you're not running a hotel, but you are in the hospitality business. So you need to treat it like one. So let me walk you through some of the mistakes I see because they show up over and over and over again, and they are all avoidable. So mistake number one, jumping into real estate investing before your existing business is clean. I see this constantly. Someone hears about this strategy, they get excited, they go out and buy a property. But their current business has messy books, it's got the wrong entity structure, and they're missing deductions that they're already entitled to. And now they're just going to add another business on top of that? Don't add complexity to disorder. Get your foundation right first. So the short-term rental strategy is powerful, but it doesn't fix underlying problems. Mistake number two, buying too small. Yes, I know many of us want to avoid risk when we can, but a $250,000 property is not going to generate losses to offset a lot of your $400,000 of business income. You have to underwrite these deals against your actual income target before you fall in love with the property. The math has to work, or you're just adding property to your life without solving the problem and getting those additional benefits. Mistake number three, treating it passively. If you buy a short-term rental or you invest in a short-term rental that somebody else is completely running for you, maybe you're a limited partner, or maybe you hand everything to a management company and you never touch it, you may not meet the participation requirements. You have to be involved in the business decisions and you have to document it. Mistake number four, expecting 1 year to solve all of your tax problems. This is a compounding strategy. Year one, you offset a large chunk of your income. Year two, you acquire another property, plus you still get some benefits from the first one. And then by year three, you're refinancing your first property because it's gone up in value. You're pulling out some equity tax-free because you don't pay tax on debt. And then you can use that capital to fund the next acquisition. So the long-term play here is building a portfolio that generates paper losses year after year, while appreciating in value and producing positive cash flow. So one property is a good start. A portfolio is the end game. Mistake number five, taking shortcuts that bring risk. There are these real estate syndications out there, conservation easements, certain solar investments that promise to let you just write a check and eliminate your taxes. And some of them work, but a lot of them are on the IRS radar and have been partially or fully disallowed after audits, or now they're hung up in years of expensive litigation with the IRS. So you didn't really just save taxes, you bought yourself a problem. Do this the right way and you don't need those shortcuts. So here's the sequence, and I want you to remember this. Your business is generating income, and that income deserves to be protected. First, make sure your bookkeeping, your entity structure, your foundational deductions are handled. That has to come before anything else, or you're building on a cracked foundation. Second, identify and acquire the right short-term rental property, sized correctly for your income, with real cash-on-cash return and a rental history you can verify. Third, run the cost segregation study with a reputable company. That's not optional. This is where the leverage lives and where the strategy actually works. And then fourth, document your participation from day one. Track your hours, keep your records, treat this like the business that it is. And if you do these four things, that six-figure check you've been writing to the IRS every year becomes a very different number. And you own assets. You're building something. That's the whole point. At Pennywise, there are two reasons why our business exists, and they kind of change depending on the day. Some days we come in focused on defunding the IRS. Other days, we just want to help our clients pocket more profit. Moves like this is what defunding the IRS and keeping more of your hard-earned money actually looks like. And if you're making real money and you haven't had a real conversation about how to protect it, that's the next step. The link below takes you to book a strategy session with the Pennywise team. We'll look at your income, run the numbers, and show you what the right entry point is for your situation. And if this changed the way you're thinking about what's possible on your tax bill, there's a lot more where this came from. So hit subscribe so you don't miss what's coming next.